Hey, everybody, welcome back to STRonomics. I'm Bill Faith. This is Kenny Bedwell. Today, we're going to be talking about forecasting future revenue, which is what Kenny was just doing for me, right?
Yep.
How do you forecast future revenue, Kenny?
Oh boy.
And I guess before we even go down there, why is that important?
So as we've seen, the market changes, and we can't just necessarily rely on the last 12, trailing 12. And moreover, we can't just say, hey, look, what did this market do in 2019 pre-COVID? I mean, you can, but it doesn't necessarily mean it's going to be that accurate either. I'm seeing markets do better than 2019 today, and some doing worse than what they were doing in 2019. So it's more about understanding, like using history as a guide, but then looking at different models to project the future. So, and that's the key word, models, not model. So that's generically what I typically tell people.
So let's start with what are those models? What do they look like?
Okay, so really, when I say models, it's about creating a revenue range of what can happen in, say, a set period of time, given the current market conditions. So we've talked about this before, and we talk about it in the accelerator about a good, better, best scenario, or worst case scenario, obvious case scenario, and then best case scenario, and understanding what that potential can look like. So typically what I like to do is first, I will start out using historics kind of as that guide to understand how properties are currently doing and how they're based on tier levels. So I like to see what properties, in the last 12 months where they fall in a sort of kind of revenue percentile basis. So, and basically what I'm saying is, take your property, how is it performing today in a current revenue percentile? And then looking at historic percentiles as well and seeing where that property would have fallen there as well. So you're getting different ranges of revenue potential that it's done over time. So say it was in the 80th percentile today, I would like to see what it was in the 80th percentile in 2022, 2021, 2019, and so on, trying to get all that data together to I understand how that 80th percentile has grown over time. All right. The other thing too we want to look at is market supply. How is that increase in my market, and how saturated not only is the market, but the bedroom count too. So if we take an example like Kissimmee and we look at 2 and 3 bedrooms, there's thousands and thousands of them, and that has grown over time as well. So but whereas like you look at like an 8 bedroom or a 9 bedroom, sure, there's more and more over time, but there's not as many. That percentage growth difference is different than like a 2 or a 3. So it's not as saturated when we compare the demand. So saying that, oh, wow, this market is saturated really isn't the thing. It's based on bedroom count. So when we look at kind of trying to tie all this back together, when we look at saturation and growth of that market, and we look at current historics and we put those two together, that gives us a better idea of what to model out for a revenue projection.
Okay, now that you've explained that, how do I do it in layman's terms?
In layman's terms, okay, that's the fun part. Um, like, there's a lot there. So here's what you want to do. It just goes back to the whole good, better, best. What do you believe the worst case scenario is for a property that it's going to do? And what do you think the best case of it can be? All right. And run a pro forma on each one of those. So if I believe this property, looking at the last 12 months, okay, I'm going to use a historic here. In the last 12 months, this property is making $100,000. Okay. If the market took a 20% dip, and I only made $80,000 worst case scenario instead of $100,000, how would the deal pencil out? Or how would that compare to my expenses? Or if the market, let's say that demand peaked 20%, which that really wouldn't be the case. I'd probably say like 5 or 10%. So 5 or 10% of $100,000 is what? 105, 110. How would that look for my numbers? And that'd be my best case scenario. So really, it's more of like a feel for, okay, if the market took a dip of a certain percentage amount, and based on current income, what would that look like? That's probably the best way a lot of people are going to be able to do it and more accurately project what they're going to do over the next 12 months.
All right, Kenny. So I've never done this before. Where do I find this information? How can I get access to this?
So the best way to do to project, because really what you want to nail is the worst case scenario, right? Is that, I guess, from your perspective, is that really like, what would you want to know the most of for your revenue range?
I mean, the most important thing for me is understanding what my operational costs, my carry costs are going to be, right?
Sure.
So, like you used the $100,000 model. I know there's a ton of people that are out there that have $5,000, $6,000, even $7,000 a month mortgage payments. And, when property taxes come up, when insurance renewal comes up, and, they might have another, you factor in utilities, cable, pool cleaning, hot tub cleaning, whatever you have, just throw in another 2,000. So if you're at 5,000, 2,000, that's 7,000. 7,000 times 12, right, is 84,000 bucks. So if you are at $100,000 in revenue and you take that 20% hit, now you're losing money, about $400 a month.
Yeah.
Right. So that's worst case scenario for me. So one of the things when I'm forecasting revenue, I'm always clipping off 10%. When I'm going in and I'm forecasting expenses, my operational costs, I'm increasing 10%. Now I've created a 20% delta. That's my safe zone in there. That's how I run all of my performance. That's how I do all of my forecasting. So kind of like what Kenny said is, I mean, I want to look at occupancy rates. I want to look at average rates that are booked. I do like AirDNA's pacing feature, to where I can look over the next 6 months to see what averages are being booked, what rates, that type of stuff. And then I kind of run in and look at what's my minimum occupancy. What happens if I'm running at 50% occupancy, at a 50th or 75th percentile rate when I'm typically, well over the 90th percentile. So that's like worst case scenario. If I have to drop rates down to 50th percent, right? And I'm usually around 65, 70% occupancy, and I got to go to 50% occupancy. What is that going to do to my forecasted revenue? Then I'm going to figure out what that number would be, and then I'm going to compare that to my carrying costs, right?
Sure.
That's the big thing for me. And when you're looking at carrying costs, if your occupancy drops from 67% to 50%, you have to assume that you're going to save some money on utilities. You're going to save a little bit of money on cleaning costs. So you kind of have to really have your head wrapped around what your expenses are and your current operating costs to be able to forecast that, the expense side.
Yeah, and that's the thing too, is like so I like to look at the market saturation level. So compare what demand and supply was this year versus last year, and understand, because most markets have seen a decline, or other way around, they've seen an increase in saturation. And so if using that as a percentage difference too, to see like how has the average revenue per active listing declined, and use that as like, hey, look, you're probably going to make that percentage less on this particular property, if not more. Occupancy rate is another great way, like you were saying. Instead of getting 66%, I only got 60% or 50%, at this rate instead of that rate. And actually like seeing the different models and looking at it will help you know. But the important thing here, I think what you said is, if you're already kind of threading the needle at current projected amounts, whether you're using a free calculator or you're using the trailing 12, it's probably a risky deal.
Agreed.
Like
Agreed,
if you're not
100%.
like most deals that I'm seeing today that are decent are like 30% of the gross revenue is your profit. Only 30%.
Right.
Anything less than that, it's way too risky.
Agreed.
To even consider.
So I think, and just, I don't want everybody to think that this is just about buying a new property today. This is how you need to look at your existing properties and your existing portfolio as well. So I think 2 episodes ago, I shared with Kenny, my number one property did $357,000 for a 6.4 down at the beach in Gulf Shores in 2022. I'm looking at probably around 270, 280. That's going to be a 25, 26, 27% hit. Hopefully I can make up some of that delta. But that's really going to all be dependent on 3 weeks that are coming up in the next 5 weeks. If I end up missing 3 weeks during the summer, that's going to cost me $48,000. So what happens now, especially if you followed me for the last couple of years, it used to be, raise rates. Even as I got closer to the summer, weeks that were open, I would hold in weeks and keep them closed off, raise rates. Now it's the opposite. I'm like, okay, well, that was an $18,000 week. Well, what if I can get 8,000 or 9,000? That's a big difference in me trying to be able to hold on to, a smaller percentage of decline. So occupancy now is a player in my mindset where it hasn't been since, 2020. 2018-19, occupancy was a big deal for me, right? But then I completely got out of that and just charged as much as I possibly could, above Price Labs max, in the summer of 20 and 21 and 22. It's a completely different game today than it was 9 months ago, right? So we still had about another 5-6 weeks from this date a year ago is really when things started to slow down. We talked about this, Kenny. What does your September look like now? Your October, your November? If you go back and look at when the guests that were staying last year in September, October, November, when they booked, a lot of those were already booked, right?
Yeah.
And I get that our lead time has shrunk, but a lot of that lead time are similar people that are booking. You're going to end up with a lot of those people that always book in advance that just aren't taking vacations this year, right? And they're probably not going to take vacations next year. So then the question becomes is, what do you forecast into 2024? None of us are economists. We don't control the economy. We can't live our lives out of fear. But I can tell you right now, I'm budgeting about another 10% dip over where we're going to finish out with 2023 just to be safe.
Yeah.
Right. So that's factoring into the property I'm under contract with right now. Right. It's factoring into my existing portfolio. It's factoring into decisions. The property that I'm going to buy right now, and it's interesting, Kenny talks about submarkets and, bedroom counts. So the bedroom count that we're at in that property is, I think, the separator for us, Kenny. There's a ton of 4 or 5 bedrooms, but there's not very many high quality, at least that we can find, at 7, 8, 9 bedrooms, really that 6 to 9 range. And that's because we're buying into that size. I think we're going to be able to stand out in that market, right? Plus the hosting sucks in this market. It's really bad. It's worse than some of the others that you and I have talked about. So that gives me a little bit more positivity, going into this investment than if I was going into a Gulf Shores or going into a Smokies or a Broken Bow, at this standpoint. The thing that's really interesting, Kenny, and I don't want to go back. I know you mentioned Broken Bow earlier. You mentioned, and I said Blue Ridge. And I think you said Logan. I did not. No,
I did not say.
I'm just kidding. So the thing with like Broken Bow and Blue Ridge, those are markets that blew up during COVID. What's the attraction there? What's the traffic driver? Right now, great weather, people getting out of Tulsa and Dallas to go to Broken Bow, people getting out of Atlanta to go to, Blue Ridge. But what happens September, October, November, January, and February? I don't know. It's just as easy for me to drive down to Orlando or Tampa, or the beach where it's warmer during the winter than it is to go to Blue Ridge. I get it might be 4 hours versus a 2-hour drive to get to Blue Ridge. But these are the things that we have to consider and look at what the market shifts are happening and where people are spending, their dollars. That's something that becomes really important to understand, and why you want to keep your finger on the pulse of how spending is happening. I've been in the retail space since 2003 with businesses and shopping malls. And one of the biggest indicators for the health of consumer spending is what happens on Black Friday through Cyber Monday. And that typically carries over through Christmas spending, right? So I know this is coming out way in advance of that, but when we get to that time of year, you need to keep an eye on that as well. Now go look at General Growth Properties, Simon Properties, the 2 largest shopping mall and commercial real estate holdings in the country. When they do their reporting on a monthly basis, keep an eye on their stock price, because that 100% is driven by consumer spending. These are things that we need to be looking at, because you may say, well, people going to Forever 21, to spend money or going into an Apple store doesn't affect me. The fuck it doesn't. It 100% affects what's happening. Kenny knows this. He used to work for one of the largest, banks, in the world. And you're doing deeper research like that's impacting consumer spending habits, correct?
Yep.
So I'm not telling you you don't have to go look at stocks and all that type of stuff, but look at some of these players, because the consumer spending habits start at the smaller level. And well, let me rephrase that. They start at the higher level for us, and then they matriculate. It's much easier to cut out $1,000 or $2,000 or $10,000 or $15,000 a week or a night stay as it is to cut out buying a new watch band for my iWatch, right? So since we are all in that higher tier, and most of us are discretionary income, we are not non-discretionary income, because a lot of us aren't dealing in, that business travel world. Most of us are in discretionary vacation markets, that type of stuff. And even if you're in the urban area, unless you're dialed into, the traditional midterm, nurses, business travelers, that type of stuff, that's where we can get hit. And I think one of the things it used to be, Kenny, that we could kind of insulate ourselves, not being in Hawaii, not being in Miami or Puerto Rico, the fly-in markets where it was the drive-in markets. But we're already seeing that, like Broken Bow and Blue Ridge, they're being impacted just as well as Gulf Shores and Destin, is as well. And we're not just picking on these two markets. It's because it's happening all across the country. And what I think is going to happen, and it's interesting because I'm investing into a big market right now, but I think the smaller markets that we don't talk about that have traffic drivers, like the ones with, smaller national parks, smaller ski resorts, that type of stuff, I think those are the ones that are going to actually stand out and potentially thrive, over the next 12 to 18 months. What are your thoughts on that?
Yes. And I think that we are going to see investors, a little more hesitant to pull the trigger on short-term rentals at price points where it doesn't quite make sense in terms of revenue. Like, we're going to see more and more of investors say, no, it has to be at this ROI in order for me to even consider, which none of the I wouldn't say none of them, but most properties right now for sale aren't even close to that level. So we're going to see this like at a certain point when the market stabilizes, because what's about to happen, a lot of people are getting burnt in this market. And so we're going to see where there has to be some sort of buffer. So whether you're looking at a new property or you're looking at your current property, really what I would say, I mean, if you want to go back and listen to how I broke everything down and saturation and history and things like that, that's great. But ultimately, the question I really asked yourself is, can you take a 20% hit? And the answer is no. Then one, you probably shouldn't consider that property. Or two, you might consider pivoting if you're in that property right now. Because you're headed.
When you say pivot, are you talking going from short term to midterm to long term? Or are you talking about selling?
Sure. It could be anything. It could be go to midterm, long term. It could be selling. It could be selling and going into another market. It really just depends on what your investment strategy is. So
if you're struggling right now, you are either don't have good enough photos, don't have a well enough designed property, a good enough location, or you bought wrong. You bought at the height of the market. And that's what most of you that are struggling probably just didn't buy well enough, right?
Correct. That's exactly what the case. You didn't buy well, and you probably didn't calculate the expenses appropriately.
You bought somebody in 2021 or 2022 that was already, I wouldn't say the height of the market, but on the upswing, that was selling you a property that was, if you paid 800, they paid 450. For that property, and it made sense for them, but it's not making sense for you at 800. So those are all things that we need to look at as we're doing our own internal audits. I can't tell you that if you're watching this episode, go back 4 episodes, because the last 4 episodes are pure gold that every one of you guys, need to listen to. There's no question. And it talks a lot about some similar scenarios that we're going through right now. It's forecasting, it's budgeting, it's auditing, it's what to do if you're losing money. It's all of these things that are really important, because if you're not there yet, you might be there in a couple of months, specifically if you've purchased after May of 2020, right? And it's really interesting, Kenny. the majority of my properties I've purchased because I've continued to level up. But hopefully I don't fall into that position.
Yeah.
But and that's one of the things I do like about having bigger properties. Sure, there's more debt, but you have that higher revenue, higher cash flow to where you have a little bit more absorbance. I think the ones that are going to be really in trouble are the ones that were in the $300,000 to $600,000 range that were only doing 80,000, 90,000 to start with, and then they take that 18,000, that $20,000 hit. They just don't have a big enough delta from a cash flow perspective, in there. You know what I mean?
Yeah, and I'll say this too, especially with new properties, beware of people, realtors, anyone who says, well, the potential of this property is this. They don't know what they're talking about. So like just be cognizant of that. Finally, I just want to say, like, nobody has a crystal ball, including ourselves. And I'm seeing a lot of people like talk about like, oh, we forecast, and I'm not going to name names, but we're forecasting like the market to do this, this, and this. Well, a property in a market, like our properties are in sub-markets within the entire industry. And so what the industry does is going to be completely different than how your property performs. And so, and then furthermore, we can't really project a full year out. Like what if another COVID happens, or what if there's a war? Like all these different things, like we don't know. So we have to like insulate ourselves, like you were saying, Bill, and just say like, if I took this hit. So being pessimistic about deals, in my opinion, or bearish, approaching it bearish, but you're looking to buy or looking to, continue in a market, but saying, well, if I took a hit, how bad would that be? Versus, you know what, I'm going to be super optimistic and hope for the best. Sure, you
Be
can be that, but
cautiously
like, don't run your numbers
optimistic.
off that, So
Cautiously optimistic.
that's a great way of saying it. Don't be
in the good, better, and best scenario. You need to produce the best, but you better be budgeting off of the better, right?
right.
Somewhere either better or between good and better, right? And you should never go higher than that. I mean, I usually budget off the 110 to 125th percentile. Right now I'm budgeting at about 100 of the 100 percentile, right? And I know a lot of people, well, what do you mean? RDNA, STR Insights only goes to the 90th percentile. So we've talked about the mastermind markup at 30%, and mine's usually around 55%. But I'm not budgeting on that today. I can't because it's getting harder and harder, for me. And a lot of that has to do with going back to being the marketing guide to the marketability of your property, right? If your property is not marketable, then you need to make it marketable, or you
in the right location.
Yeah.
Like if you're like, here's a good example. Properties, I use the lakefront one because that's what I'm on. Like lakefront versus non-lakefront. If you're non-lakefront, you're more likely going to see a bigger hit than lakefront properties.
And dude, there's only like 2 or 3 lakes in the country that you can be non-lakefront. You have to be lakefront. Maybe a Flathead Lake or whatever the name of that big ass lake is in Arizona. I can't remember the name of it, but there's like less than a handful of lakes that you can be off the lake and have a good
Powell.
Yeah, exactly. And have a good short-term rental. Everything else, it's about lake, and it's about the views, on that lake as well.
Yep.
I can't emphasize, Bree and I, we were down at our lake house, Kenny, last week, and we went and looked at a house in our neighborhood, literally a quarter of a mile away, and it was nicer and more expensive than the one that we had. I wanted the bigger house, the bigger bedroom. So I'm not saying I was not even interested in buying, because it was like $400,000 to renovate. Big house, but like still 2006 Golden Girls. But we walked in and the pool was amazing. We don't have a pool, all this stuff. But you know what? The view was about a 7 out of 10. We have the best view and the best location on our lake. These huge long range views. And even though across from this house there was no homes, but you only had like 150 yards of water to be able to see from half the view, you only had to be in this certain spot to be able to see out onto the main channel. That cuts like probably 30% of my overall marketability, right? And just because of that, even if it was like a $2.2 million, purchase, even if I could get it at 1.5 or 1.6, I would not buy it because I lose the marketability on it. So I think that's one thing right now that all of us should look at our properties And because we're not just talking about buying, what is the marketability of your property? Like literally, if you don't know, that's my Instagram right there, BillFace73. Send the link and ask me, Bill, what's the marketability of my property? And I'll tell you straight up if you got it or you don't, right? And if I can't see it, you better fucking find it out, or you probably need to add something or look at getting a different property, to be honest with you, because you have to have some place to hang your hat today.
Yep.
If you don't, you're just average. And if you're average, you're going to get crushed, especially when we get out of the summer. Is that it? We done?
Yeah, I mean, there's a lot to chew on here, I think, and I mean, if you haven't realized it, there isn't like really a very straightforward way to accurately forecast future revenue of a property. I think that's gotten pretty clear. You have to take a look at several different variables. You have to take a look at the current market conditions, the saturation of the market, where your property is located, the marketability of your property, just like all these different things that really make up how revenue is generated in short-term rentals. And so it's not like very clear, and it's not something that Bill and I can say over a podcast. This is what you do, and this is how you calculate it in this calculator. It doesn't exist.
Was that your Bill voice, by the way? This is what you do.
You want me to do the Bill voice?
No, don't.
I need to speak.
I agree, Kenny. There's a lot of factors.
But yeah.
There's a lot of factors that have to be considered.
Yes.
And location, views, quality of your photos, carry costs, marketability, all those things. And I just want to reemphasize, in the previous episode, Kenny said that he bought a hot tub for his Watkins Glen. It's not just about buying an amenity. It's about how it's leveraged, right? And the positioning and leverage of everything that we do in business. It makes or breaks the deal. I can't emphasize that enough. And we are running a business. For most of you, even if you are an entrepreneur, what you're investing into properties is probably the most you've ever invested. For me, it is. I'd never spent over $100,000, Kenny, to start a business. Most of my businesses, I started with $25,000 or less. And now I'm, $200,000 for $1 million property. It blows my freaking mind, to be honest with you. So I just want to end this with, this is not a doom and gloom podcast, right? It's, if you're struggling, you need to look through this lens and look at these things to be able to improve. I just pulled up my stuff. Even though I'm down on my number one property, Kenny, which I think we'll make some of that up. I think I'll get some of that booked through the summer. I'm down 3.7% year to date on my total portfolio. That to me is not that bad. And I have an opportunity through the summer to put that into the positive to increase over 2022. If I can come out even Steven at the end of 2023, like roughly where I'm at now, down 5%, up 5%, 100% even Steven, I will be tickled pink. But the one thing I'll tell you is I'm working about 3 times harder, taking 3 times more time, putting it into this. And that's one of the reasons why I'm trying to right size my portfolio. And I'll probably even sell another one of my underperformers, because the more properties you have, if you self-manage like Kenny and I do, the less time you can put into each individual property, right? So for me, it's about optimizing properties today. It's not about, really being in growth mode. If you hear me talk about I'm buying a property, I can promise you I've either already sold one or I'm selling one, before I go and I purchase. So think about the optimization of your time and your effort and how you're putting that into your portfolios. The set it and forget it days of COVID are definitely gone. Awesome. Great job, Kenny. High five. Yeah. It's kind of hard on these things. It's backwards.
It is opposite of,
we'll put that into the bloopers.
Yeah, I know, right?
That's funny. Awesome. Thanks for joining us, everybody. Please, if you're listening to this on Spotify, Apple, Amazon, wherever, please take a second and just leave a review. It would mean the world to Kenny and I. Would really appreciate it. We look forward to
share it with a friend. If you know a friend who's struggling in the short-term rental space, share it with them or in a Facebook group or something.
You know what? That's a great ask, honestly, because we don't get enough listeners to this. And there's so many people that reach out to us. I know you get it like I do. Like, oh my God, I never thought of these things. You put it into this perspective and you kind of give the data and then I give the unfiltered pun intended, version of, what needs to happen. And yeah, please, you know what, even better than a review, share it with a friend, put it into a Facebook group, because if it helps you, it's going to help somebody else. And that's probably the most important thing for Kenny and I, is we just want to help anybody, whether you're doing great right now or whether you're struggling. Just takes 5 seconds to hit the share button off of YouTube, or share the podcast link from wherever you're listening to it into a Facebook group or a text message. We'd really appreciate that. Thank you, everybody, for being here. We'll see you on the next episode.